Prasun, you've been managing money and investing it for a very long time. I know we can't talk about future projections, but we can certainly talk about the past.
Right.
You said that lots of events happened in the recent past, and even if we go to 2008 when you were still managing, and maybe even before that, after all of this, you've had a US meltdown, you've had, conflict in the region, etc., etc., etc. How have the returns been? Have you been able to deliver, far better than inflation-adjusted returns?
So let's look at the Indian equity markets. I think despite all the pushes and pulls, despite all that, let's take last 30, 40 years, India has been through everything. We have been through wars, we have been through an emergency situation, we have been through minority governments, we have been through political issues where governments have not lasted more than a year. I think we have seen where we have corporate scandals, stock market scandals. I mean, we have seen everything. Despite that, the equity markets on an average are giving you close to mid-teen returns. So, I think that itself is a lesson in itself, because if over a long period of time, as you said, inflation has averaged between say close to 6.5%, if equity markets are even giving you, forget 15% return, even 12-13% return, which they have despite everything, I think that's a very, very good return to have. So very clearly the lesson is in a growth economy like India, where your nominal GDP growth at least is close to double digits for the last say 20 years now. In that kind of a scenario, if you believe the market earnings will compound at even say 12-13%, and in fact earnings have compounded at better than that, even with reasonable multiples, you should be able to get that kind of a return over a long period of time. I'm not saying 25% return, I'm saying 12-13% return looks reasonable as long as your growth remains in the 10-11% vicinity, which I think is a fairly reasonable assumption to make in a country like India with a real GDP growth of say 7%, inflation of close to 4%, you come to 11%. And with earnings growth of say 12-13%, because a lot of the parts of the economy are not really represented in the stock market, the weaker parts are not represented. So agri which doesn't grow is not represented in the stock market. So stock markets earnings tend to grow at slightly higher than nominal GDP over a long period of time. Now you put that together, eventually markets are servants of earnings growth. And if you get that earning growth over the next 10, 12, 13 years, I'm not trying to project here, then logically speaking, barring a real meltdown of multiples, you should be able to make these kind of returns over a long period of time. And that is, I come to my first point, start early. I think you will have these cycles, you will have those phases, you will lose 20%. Those are inevitable in the equity market. This is a volatile asset class.